Hi, let me begin with a simple but powerful question. If you had to buy a business today, how would you decide what it is worth? Would you rely on what the owner originally paid? Would you rely on what someone else is willing to pay? Or would you estimate the future potential of that business? That decision making process is called valuation. In its simplest form, valuation is the process of determining the economic worth of an asset, business, or an investment. An asset can be anything. It can be a business, brand, or intangible assets, real estate, financial or non financial instruments. Valuation answers one fundamental question: what is this worth today, given the benefits it is expected to generate in the future? Before going deeper, we must clearly distinguish between price and value. Price is what is paid in a transaction, whereas value is the intrinsic worth of the asset. These two are not always the same. Consider a real estate example. Two apartments may both be priced at $100,000. One is located in a prime area with strong future infrastructure development. The other is in a stagnant locality with limited demand. Even though the price is identical, the underlying value may be significantly different for these two apartments. Valuation attempts to estimate value, not merely observe price. Let us consider a small business example of a coffee shop. The annual revenue of the coffee shop is $200,000. Its annual expenses are $150,000 and the annual profit is $50,000. Now, suppose someone offers to buy this cafe for $40,000. Would that be reasonable? Most likely not, because the business earns $50,000 per annum. In less than 1 year, the buyer recovers the investment amount if this coffee shop is sold for $40,000. But suppose the offer is for $500,000. Is that reasonable? Now the answer depends on a deeper analysis. Will the profits continue? Are they growing? How stable is the customer demand? How competitive is the market? What risks are involved? This is valuation in action. We are no longer looking at historical cost. We are assessing future economic benefit and associated risk. At its foundation, valuation rests on two pillars: future cash flows. What economic benefits will the asset generate going forward? In business valuation, this usually means profits, cash flows, and dividend. The second pillar is risk. How certain are those future benefits? Higher uncertainty means lower present value of future cash flows, and low risk means higher present value of future cash flows. Valuation is not just an academic concept, it drives major financial decisions. Valuation is required for mergers and acquisitions, private equity investments, startup fundraising, ESOP issuance by companies, IPO pricing, accounting compliances, regulatory compliances, disputes resolutions, and strategic planning. When investors invested in companies like Microsoft, Google, Facebook, or Tesla, they were not guessing. They performed structured valuation analysis to determine whether the investment justified the expected returns. Without valuation, capital allocation becomes speculation. One common misconception is equating cost with value. Suppose a company invests rupees 500,000 in building a manufacturing plant. Does that automatically mean that the plant is worth $500,000? Not necessarily. If the plant cannot generate adequate future returns, its economic value could significantly be lower. Similarly, a startup built with minimal capital could have very high valuation if its future growth potential is strong. Valuation is forward looking. It is not based solely on past expenditure, it is based on expected future performance. Is valuation an art or a science? Valuation is often described as both a science because it involves financial modeling, discounting techniques, and quantitative analysis. It is an art because it requires judgment, assumptions, and interpretations. Two professionals using the same data may arrive at slightly different valuations due to different assumptions about growth, risk, or market conditions. Therefore, valuation is not about finding a single correct number, it is about arriving at a reasonable and defensible estimate of value. In executive decision making, valuation helps questions such as: should we acquire this competitor? Is this startup worth investing in? Are we overpaying for this asset? What is the fair value of our company? Ultimately, valuation supports better capital allocation. And in business, capital allocation is one of the most important determinants of long term success. To summarize, valuation is the structured process of estimating the present economic worth of an asset based on its expected future benefits and associated risks. It is a decision making tool, it is a capital allocation tool, and in many ways, it is the foundation of modern finance. Thank you.